Good morning. We continue with economic growth and GDP. Today we want to focus on the limitations. When we talk about national income, it simply talks about measuring the economic performance of a country, or how is our economy performing compared to other economies. That is what national income is all about. We don't just get these figures because we need to get them. We get them because we want to use them for comparisons. Probably we want to compare this year with the previous year, or we want to compare our country with other countries. These are the reasons why we have national income figures. Do you get what I'm saying here? Those figures are not, we don't just get these figures because we need to get them. We get them because we want to use to measure our performance as a country. We can measure our performance based on the previous year compared to this year. Oh, the figure for this year is 10,000. Or the figure for last year is 7,000. That means we are progressing. That's performance. Oh, we want to compare our country with other countries. Oh, the figure for our country here is 10,000. But the figure for other for country B, country C, or D are not up to ours. So we are better than country A or country B, C, and D. This is why we have national income. Do you get that? So in the course, do we get it, please? Yeah. In the course of measuring this national income, as soon as we measure it, we measure the performance of the country. The next thing we think about is, how do people live in that country? Are they living well or not? Is there poverty in that country or not? So now that we have these figures, does this figure reflect in the life of those people in that country? That is living standard. Do we understand what living standard is? How we live in the country, our spending, our consumption. What are those things our ability to buy? That is what living standard is about. Not just the basic, not the basic things like food, clothing, and shelter. What else can we do? What else do we have income to spend on? That is what living standard is all about. So what is the problem about using GDP, which is the gross domestic product, or the GNI, to measure the living standards between countries? So that is, we want to talk about the limitations. So the first one here is, about, what's it called? Accounting concepts. Different countries have different accounting concepts. Some countries, they are, in accounting concept simply means ways in which we put our accounting, how we put our accounts in the country, how we put it. Oh, we use depreciation. How do we use depreciation in this country? How do we use depreciation in that country? Some countries, they might use reducing balance method for depreciation. Other countries might use straight line method for depreciation. Some countries might use revaluation method for depreciation. So it means different countries have different ways of calculation. So because they have different ways of calculating their GDP, it means that we might not have the same figure. Get the point here. GNI is GDP minus depreciation. And in depreciation, we have three methods of calculating depreciation. We can use reducing balancing method. For reducing balancing method, it simply means, this is accounting anyway, but I just have to explain. For reducing balancing method, it means we have the cost of that asset minus the net book value, then we have a depreciation value. So whatever depreciation value we want to use, it has to be used on the net book value, which means depreciation minus the amount of money, the cost of the product minus the amount of money we have put aside in case the asset declines. That is for reducing balancing method. Another method of depreciation is straight line method. For straight line method, we only calculate through the percentage given. Oh, 10% of the asset is 10,000. 10% of 10,000, then we get the value. So using 10,000 by a percentage is different from finding the amount of money you have put aside. You take it away from the cost before using the percentage. Are we going to get the same thing? No, let me explain what I'm saying here. For reducing balancing method of depreciation, it is the cost of assets minus the net book value. Then you use the percentage, maybe 2%. So if this is 10,000, the net, let's say the provision for depreciation is 3,000. So it means we have to take this away from this before we do the percentage. That is reducing balancing method. This is one way to calculate depreciation. Some countries might not use this. They might use straight line method. For straight line method, we only have the 10,000 multiplied by 2%. Are we going to get the same answers? Are we going to get the same answers here? No, we can't. Because here, we are going to calculate the provision made for depreciation. We are going to take it away from this. So it means we are going to calculate on 7,000. 2% of 7,000. That is the amount of depreciation. Here, it is 2% of 10,000. So we're not going to have the same figure. Do you get the point I'm making or not?
Yeah.
So different countries have different accounting concepts. This is accounting anyway, but I just want you to understand the point I'm making here. Different countries have different accounting concepts. So a country might use reducing balancing method. Another country might use straight line method. There's also revaluation, which means the asset of now minus the asset of the previous asset minus the present asset. So we're not going to have the same figures, despite the fact that we have the same number in terms of cost. It's 10,000 here, it's 10,000 here. But for the fact that we're using different depreciation method, we're not going to have the same value. So because we don't have the same value, it means we might not be able to compare the living standard in that country. Do you understand the accounting concept here? Do you get it or not, please?
Yeah.
There's depreciation, which is our GNI, which is GDP minus depreciation. That is the formula for GNI. But the point is, depreciation is the same, the wear and tear of assets. But the way we calculate our depreciation differs. Country A might use reducing balance method. Country B may use straight line method. Country C might use revaluation. But all of them are calculating for GNI. So we're going to have different GNI figures. So that means, because of accounting concept, we might not be able to compare living standards. Do you get the first point now? Do you get the first point, please? The second one, the quality of national income data gathered varies from different countries. When we talked about accuracy about national income, I talked about gathering information with mistakes. This information we gather them. We gather this data. In the course of gathering this data, we might make mistakes. Yes or no? So our national income statistic might not be accurate because we have made mistake from the beginning. So here it talks about the quality of national income data. Different countries have different level of education. Some countries are more educated than others. Yes or no? Good. So if country A has well-educated workforce that does its national income statistic, it might be giving us an accurate figure. But if country B has average educated workforce, those average educated workforce might not be able to get the right information. So it means there's inaccuracy in the statistic gathered. That is the quality we're talking about. There's quality based on the expertise. So if you don't have experts that can give you the data that are accurate, then whatever figure you have will not be equal, will not be accurate. So how do we compare countries with countries when we are getting figures that are not accurate? Do you get it or you not get what I'm saying here? Quality of national income data gathered.